The silent crash behind the screens. It began without headlines, without panic, without a single dramatic chart shared across social media. Prices didn't plummet. Markets didn't halt. There was no crisis, at least not one visible to anyone watching from the outside. But deep inside the financial system, a slow-motion collapse was unfolding, hidden from the public and ignored by those who trusted the illusion of stability. This story matters now because not every crash announces itself. Some build quietly, layer by layer, inside balance sheets, derivatives, shadow banking networks, and debt obligations that rarely appear on the front page. And in a world where risk is often buried under complexity, understanding the danger of silent crash is more urgent than ever. It began with a series of tiny imbalances. A credit fund tightened its lending standards. A major bank quietly reduced exposure to a certain asset class. A handful of borrowers refinanced at higher rates. None of these moves seemed significant. They were footnotes, routine adjustments, small shifts that barely registered in a market obsessed with daily price movements. But these adjustments carried a message the public never heard. Confidence was thinning at the edges. The early reveals surfaced when a mid-sized institution missed a routine funding target. Nothing dramatic, just a slight shortfall in overnight liquidity. Analysts shrugged. The stock wobbled for a day, then stabilized. Yet inside trading desks and risk departments, alarms flickered. A single missed funding target meant something deeper. Someone, somewhere, wasn't lending like they used to. Soon, the changes multiplied. Banks increased collateral demands. Funds trimmed their leverage. Money market flows shifted in odd patterns. Each move was small, but together they rewired the ecosystem, making credit harder to obtain and liquidity more fragile. Outwardly, markets remained calm. Indices climbed. Volatility stayed low. Commentators declared a period of predictable, steady growth. But beneath that calm surface, the machinery of the financial system began grinding with unfamiliar tension. And in the quiet spaces where risk hides, repo markets, interbank loans, derivatives clearinghouses, the first cracks were starting to spread. The tension grew as credit conditions tightened further, but still without drawing public attention. Lending desks noticed it first. Borrowers who once secured funding with ease now face questions. Extra paperwork, higher margins, shorter terms. Nothing dramatic, but enough to signal a shift in trust. Confidence wasn't gone, but it was eroding in thin, invisible layers. The reveals sharpened when a major corporation, one considered rock solid, failed to roll over a block of short-term debt at its usual rate. Investors didn't panic. The company paid a slightly higher yield and moved on. News outlets barely mentioned it. But inside the bond market, this was a flare in the night sky. If the safest borrowers were paying more, something fundamental was changing. Banks began hoarding cash. They didn't announce it. They didn't explain it. But their behavior spoke louder than words. Interbank lending slowed. Overnight rates twitched upward. Repo markets, normally a silent backbone of global finance, showed signs of strain. Each shift hinted at the same underlying fear. Counterparties were no longer certain of one another's stability. The early conflict took shape when a large hedge fund abruptly withdrew from a key derivatives market. The move wasn't framed as defensive. It was couched as strategic repositioning. But the vacuum it left caused spreads to widen sharply. Other funds adjusted, some stepping back, others pushing in with caution. The pricing of risk became distorted, not because markets were volatile, but because liquidity was thinning in places the public never sees. Regulators, watching the signals quietly, exchanged careful memos. They saw the same patterns: small funding misses, rising collateral demands, silent retreats from complex instruments. They knew what these signs meant. The system wasn't breaking, but it was shifting into self-protection mode. Meanwhile, the broader market remained calm, almost deceptively so. Equity indices hovered near highs. Commentators praised economic strength. Retail traders saw nothing unusual in their apps. But institutional desks felt the pressure every day. Transactions took longer. Counterparties hesitated. Deals that once closed with phone call now required layers of internal approval. The silence grew heavier. Because when a crash forms out of sight, it doesn't begin with plunging prices. It begins with people quietly stepping away from risk, one cautious decision at a time. The rupture came quietly, almost politely, disguised as a routine announcement. A mid-tier financial institution disclosed a temporary liquidity mismatch, a bland phrase masking a far deeper problem. Behind closed doors, it failed to secure enough short-term funding to cover its obligations. Not by billions, not by hundreds of millions, but enough to matter. Enough to signal that the silent tightening gripping the system had reached a breaking point. Markets barely reacted. Headlines treated it as an isolated issue. Yet inside the network of interbank lending, the effect was immediate. Several institutions halted overnight exposure to the troubled bank. A few reduced limits with others, unsure who might be next. The web of trust, thin, stretched, and quietly fraying, began to contract with sudden speed. The conflict deepened when another institution reported mark-to-market losses on a portfolio of complex derivatives. Again, the losses were small, contained, manageable, but the disclosure triggered a chain of internal reviews across the industry. Risk officers demanded updated valuations. Traders widened spreads. Collateral desks raised requirements. Even counterparties with spotless histories found themselves questioned. These actions didn't crash the market. They slowed it, thickened it, turned smooth operations into hesitant, grinding motions. Transactions stalled, flows thinned. Some instruments, normally traded with ease, became stubborn, illiquid, fragile. Still, the public saw none of it. Screens at home showed stable prices. Business news spoke of steady growth. But deep inside the machinery, the gears were slipping. Then came the moment that shifted attention into crisis. A large pension fund attempted to rebalance its exposure, placing a routine order in the bond market. Under normal conditions, the trade would have filled in minutes. On this day, it barely filled at all. Liquidity evaporated. Dealers stepped back. Algorithms refused to commit. The pension fund had to break its order into pieces, pushing prices further with each attempt. Word spread quietly through fixed-income desks. Something was wrong, deeply wrong. Markets weren't functioning normally. The silence was becoming dangerous. As anxiety crept through the system, institutions began stress-testing their portfolios. They found the same unsettling truth. A significant portion of their assets depended on liquidity that no longer truly existed. Prices looked stable only because no one was trading. Values looked sound only because nobody dared test them. By afternoon, fear seeped into rooms where decisions shaped global finance. Banks questioned interbank exposures. Funds reconsidered their leverage. Clearinghouses debated increasing margin requirements. No one wanted to spark panic. Yet no one wanted to risk becoming the next institution caught without support. Every chart, every model, every assumption hovered in a fragile balance. The market hadn't crashed, not visibly, but inside the system, pressure had reached a point where even a small shock could trigger a cascade. The silent crash was no longer forming. It was already unfolding, just in places the world wasn't looking. The climax arrived without chaos, without a plunge, without the dramatic visuals people associate with crisis. It came instead in the form of a single, stunning realization shared by the institutions that mattered most. The market stability was an illusion, and they were all standing on the same fragile foundation. The revelation hit when overnight funding costs surged unexpectedly. A rate meant to fluctuate gently spiked to levels unseen in years. Banks that had relied on cheap, predictable liquidity suddenly faced soaring costs just to maintain operations. Some hesitated, others scrambled. A few quietly asked regulators for support. The silent crash had revealed itself, not through a price collapse, but through the rising cost of survival. Behind closed doors, regulators and central bankers convened. They had monitored the tightening for weeks, hoping the system would self-correct, but now the danger was too great. A chain reaction was forming. Higher funding costs would force institutions to unload assets. Selling would reveal hidden losses. Revealed losses would trigger more funding pressure. The cycle was poised to devour itself. The emergency response came swiftly. A liquidity facility was opened, discreet, targeted, designed to inject calm without signaling panic. Only insiders understood how close the system had come to a full breakdown. Markets remained outwardly stable. Indices barely moved. News outlets ran stories about unrelated topics. Retail traders saw nothing unusual at all. But in the hours that followed, the true resolution took shape. Institutions drew on facility. Funding pressures eased. Counterparties cautiously resumed lending. The silent gears of the financial system began turning again, slower than before, but no longer grinding toward failure. For the first time in weeks, risk managers exhaled. Not in relief. Relief implies safety. This was recognition, understanding, the acknowledgement that a crash can happen without ever touching the stock charts the world obsesses over. Modern relevance echoed loudly through every boardroom, every trading desk, every regulatory office. Markets don't always break loudly. Sometimes they bend quietly, dangerously, in ways only a handful of people see. The warning signs hide in spreadsheets, in clearing data, in overnight rate anomalies that never trend on social media. The lesson was unmistakable. The next crisis might not begin with a headline. Sometimes the smallest shift in perspective becomes the beginning of a new future.